In this lecture, I'll provide an overview of equity securities. This corresponds to reading 58 in the CFA Level 1 2011 curriculum. So let us talk about the importance and relative performance of equities. As we have seen in earlier presentations, equities represents a major asset class, and in fact in addition to equities, another major asset class is bonds. And in this slide we'll just compare the relative performance of equities and bonds. From 1900 to 2008, the average real return on equities has been about 5%. Notice this is the real return which we are talking about, which means that this is 5% above the rate of inflation. And these numbers here are based on a study of about 17 major equity markets around the world. So roughly speaking, we can look at this as a global average. Now, if 5% doesn't look very high, then compare it with 1.5% for bonds, and this is actually government bonds, and this is 1.5% again a real return. So what this is saying is that in the same economies where we got a 5% real return on stocks, we only got a 1.5% real return on government bonds. Now clearly bonds are less risky, the cash flow is more certain, and hence the return on bonds is relatively low. For equities, there is more riskiness because equity values can go up and down, but on average they provide a much higher return than bonds. So the point is highlighted here. With equities we have higher risk and therefore higher return relative to bonds. The long run average ratio of US equity market capitalization to US GDP is 79%. So this just gives an idea of how large the US equity market is. And this also gives us a useful tool, because in a given year, let's say in 2006, the ratio of market capitalization to GDP was very high. So this would imply that in 2006 and early 2007, the market capitalization or the equity markets were overvalued. And then after the financial crisis of 2008, then the same ratio of market capitalization to GDP in the US was low relative to the historical average. So this is one high level ratio that can be used to determine whether the markets on average or in general are currently overvalued or undervalued. Another piece of general information is that currently the US represents about 21% of the world GDP, and the US represents about 43% of world market capitalization. So if you are more interested in this stuff, there are several useful exhibits in the curriculum. I don't think they are extremely important from an exam perspective, but they are interesting. So it might not be a bad idea to just spend a few minutes looking through those exhibits. They give you a nice overall perspective on what we are talking about here. Okay, so characteristics of equity securities. This I think is relatively important from an exam perspective. The most common type of equity is common shares or common stock. This represents essentially what's called a residual claim on a company, or sometimes this is also called a ownership stake. Why is this called a residual claim? This is because when a company generates money, first that money has to be given to bondholders or debtors, and then the money goes to preferred shareholders, who we will talk about on the next slide, and then any residual amount So any residual amount then goes to common shareholders. So the common shareholders have the most to gain when a company does well, because roughly speaking a fixed amount of money goes to the bondholders and the preferred shareholders. All the rest comes to the common shareholders. And if the company is not doing too well, then obviously it's possible that after paying off the bondholders and preferred shareholders, there is nothing left for the common shareholders. We'll talk about this more later, but very simplistically, just to plant the hook in your head, common shareholders take the highest amount of risk, and therefore it is reasonable for them to expect the highest return for their investment. Now, in this reading, we also need to understand this concept of statutory voting versus cumulative voting. When you own common shares in a company, based on the corporate governance charter of that company, the common shares might either have statutory voting rights or cumulative voting rights. And what that means is the following. Let's say that you own 100 shares in this company that has statutory voting rights. So you have 100 shares, and let's say that we have 3 positions in the board that are being voted for, and let's say that we have position 1, position 2 and position 3, and that for each one of these positions we have 2 people who are running. So for position 1 we have A and B, for position 2 we have person C and person D, and for position 3 we have Mr. E and Dr. F. So these are the people running for election. In a system of statutory voting, you can vote your 100 shares for each seat. So you can vote your 100 shares for A, and the most you can vote is 100 for C, and the most you can vote is 100 for F. So these represent your votes in a statutory voting system. Had this been a cumulative voting system, you can take all 300 votes. So you can actually, if you feel really strongly about A and don't care so much about positions 2 and 3, or don't care too much about these C, D, E and F, then you can vote all 300 shares for A. And this actually, from a small shareholder perspective, gives you more power, and generally this is preferred from an investor perspective because it makes it more likely that you can have people that you really want on the board of directors. So the quick takeaway from this, other than understanding in general what these 2 things mean, the takeaway is that in general, from an investor perspective, this system, the cumulative voting system, is better. Another thing that you need to know is companies can issue different classes of common shares. And this doesn't always happen, but you just need to be aware that certain large companies, for example, might issue Class A shares and Class B shares. Now, the rules will be slightly different for shares that belong to a different class. For example, Class A shares might have more voting rights than Class B shares, or the rules around dividends might be different. There are no hard and fast rules about exactly what needs to be associated with each class shares, but you simply need to understand that companies can issue different class shares and there are slightly different rules. The most common difference has to do with voting rights, where certain class shares have more voting rights than other class shares. And as a quick recap from corporate governance, from an investor perspective, this is having different voting rights is not considered very good. But nevertheless, it does happen and you need to be aware of it. Now let's talk about what do we mean by callable common shares. What this means is that a company, once it has issued shares, can call back those shares at a certain price. So for example, a company might say that shares are callable at $50. So this is good from the company perspective because it allows the company to retire shares, callback shares at a predetermined price. And what this might allow a company to do is reduce the total amount of dividends that it pays without reducing the per share dividend. But essentially the point to understand is companies have the option to call back shares at a given price, hence it is good for the company and not so good for the investor. A puttable share, on the other hand, is good for the investor. And what the puttable share allows the investor to do is sell the share to the company for a given price. So let's say that the investor has the right to put the share back in the company's lap, so to speak, at $60. So this puts a floor on the price of the puttable share. And again, this is good for the investor. These callable and puttable common shares are not very common, but nevertheless you need to know the definitions, and when we do fixed income securities, there this concept will come back again and it will be much more important then. Now let's talk about preference shares or preferred stock, as they are sometimes referred to. As I briefly explained on the previous slide, when the company makes money, generates income or generates cash flow, the first right on that money is with the bondholders or debt holders. Next comes preference shareholders. So preference shares have some characteristics of debt and some characteristics of equity. So debt, equity or common shares, and preference shares fall somewhere in the middle. Some characteristics of equity, some characteristics of debt. Generally speaking, since preferred shareholders take less risk than equity, it is also reasonable to say that they should expect a lower return relative to equity. A common situation with preferred shares is that they are issued at a certain, or there is a certain par value of say $100, and then a fixed preferred dividend of say 10% is declared, which means that investors who invest in preference shares will get 10% of 100 as their preferred dividend, and companies in general do their best to make these preferred dividend payments, and if these payments are not made, that is generally considered bad for the company. So often this is not legally binding, but effectively companies do everything possible to make their preference share payments. Within preference shares, there are various categories. So you can have what's called cumulative preference shares versus non-cumulative. With cumulative preference shares, what happens is, let's say you are talking about dividends in year 1, year 2, year 3, year 4, and for some reason the company is not doing well in year 1, so it does not pay any preferred share dividends. And then again, let's say in year 2 it still could not pay any dividends. What will happen then in year 3 and 4, if these are cumulative preference shares, then before the common shareholders can get any dividends, the cumulative preference shareholders have to get their dividends. So essentially what was not paid out in year 1 and year 2 accumulates and needs to be paid out when the company has money. So this needs to be paid out before the common shareholders get their dividends. In non-cumulative, essentially the preference share dividends do not accumulate. So if this was non-cumulative, then essentially in year 3 common shareholders can get their dividend. So in that case, essentially the company does not have to go back and pay preferred shareholders dividends for previous years. Participating versus non-participating preference shares simply refers to the fact that in participating preference shares, the preferred shareholders also to some extent share high profits. So if profits exceed some benchmark level, then preferred shareholders might actually get more money than is stated in the regular preferred dividend. So participating means that they participate in profits. Non-participating preferred or preference shares do not participate in any profits. There they simply get the agreed upon percentage of par value. Convertible preference shares give the owners of the preference shares the right to convert to common stock. And again, this is an option that benefits the investor, because when the stock price goes up, if it is suitable or beneficial to the investor, then he can convert the preference shares to common stock. Now, this will happen over and over again in terms of you need to figure out whether a given option or a given feature benefits the investor or the company. And the way you can think of it is whoever has the option is the one who is benefiting. So with the convertible preference share, the option is with the investor. So clearly any rational investor will only exercise that option when it benefits him, and hence convertible preference shares benefit the investor. A few general points. Typically the dividends on preference shares are higher relative to non-convertible shares, and the conversion option becomes more and more valuable as the share price goes up. As you might imagine, preference shares have less risk than common shares because the dividend is stable. So if you compare these preference shares with common shares, or the preference shares with convertible option, if the share price is low, then the investor will just maintain the preferred shares and get his decent dividend, so he benefits there. If the share price starts going up, then the preference shares can be converted into common shares. So clearly convertible preference shares, even though they have some characteristics of common shares, but they are less risky than common shares, and hence the expected return on these will be lower than the expected return on common shares. And now let's talk about another class of investment or equity investment called private equity. So private equity is generally issued to institutional investors through what's called private placement. So we are going to talk about examples of private equity in more detail on the next slide, but the general idea here is, let's say a company wants to sell 20% of its stake, and if that 20% stake is sold to, let's say, a pension fund, then that would be an example of private equity. So this is a small but growing market, and the private equity stake is typically is in fact not traded on public exchanges. That's why it's called private equity. And since it's not traded on public exchanges, there are very low reporting costs. The quick point here is companies that trade on an exchange such as the New York Stock Exchange have a tremendous amount of cost associated with fulfilling reporting requirements, because these shares are being traded in public. However, for private equity, the reporting requirements are lower, and hence the reporting costs are lower. As you might imagine, private equity investments are relatively illiquid. So if a pension fund owns 20% of a given company and it wants to sell that 20% stake, it might take a while to sell that 20% stake. Generally, an investor in private equity needs to have a long-term focus. So if you invest 20% in a given company, typically you would do this because you are optimistic about the long-term prospects of the company. and you would only get into a illiquid investment if you have that longer term focus. And given that long term focus, you are also hoping for potentially higher returns. And if you make this investment, and ultimately let's say you make this investment in a small company, when that small company goes public, then there is a potential to make very high returns. So now let's talk about the different kinds of private equity. One type is called venture capital. So I'll give you a simple example here. Let's say we talk about my little company, which is currently a sole proprietorship. Now, if some venture capital, so if I have plans to become one of the largest online training companies in the world, and I need some money to achieve that dream, so what I might do is approach a venture capital company or approach someone with money, and let's say that they make a $2 million investment in my company, and they demand that for that $2 million investment they take a 30% stake in my company. So this would be called a venture capital investment. So it is private equity in the sense that some entity which has invested 2 million now has a 30% stake in IFT, and hopefully, let's say after 10 years when IFT goes public and is worth say 200 million, then 30% of this 200 million, which is 60 million, will go back to the venture capital. So look at the long-term focus and the relatively illiquid investment. More on this when we do alternative investments. A leveraged buyout, also called LBO, is when money is put into a firm that is already running. So unlike VC, which is venture capital, which is used to fund startups, leveraged buyout is used for established companies that are running and they have a cash flow. So the general idea here is, let's say that you have this company called company XYZ, which is running and has a certain cash flow. So with leveraged buyout, what an entity might do is, let's say that this company is worth 100 million. In leveraged buyout, a leveraged buyout company might put in 20 million of its own money and borrow 80 million. So use the 100 million to essentially buy this company, and it's called leveraged buyout because we are heavily using leverage. So remember, the 80 million was debt. So we use this money to buy out the company, and then over the next few years, this leveraged buyout company will pay off debt, and this company will also try and improve the efficiency of this company and increase market value. So let's say that in 3 years' time, this company has a market value of 200 million because of the wonderful job done by the LBO entity which bought this. And then let's say that by this time, from the cash flow generated, the debt is also paid out. So essentially, with the initial equity investment of 20 million, this company can then after a few years be sold for 200 million. So that is effectively a 10-fold increase. But here again, there has to be a certain time for this to happen, and this 20 million investment is clearly not liquid. Next, management buyout or MBO. This is effectively like a leveraged buyout where the equity is being provided by the management. So this is where the management of the company, let's say the management of XYZ, somehow raises 80 million debt, puts in 20 million of its own, and buys over this company. So when a leveraged buyout is happening or is done by the management, that's called a management buyout. So let's now talk about private investment in public entity or PIPE. Let's say that this public company is in financial trouble and cannot raise equity through regular sources. What this company might do is then approach an institutional investor and give that institutional investor a 30% ownership stake in the company, and obviously in return the institutional investor will give a certain amount of money. So this, from the institutional investor perspective, is a private investment in a public company, and typically this investment would happen at a value that is lower than the market value of the stock.